3.1%. You know, as I say, I'm an academic. I study interest rates. I teach interest rates. There's two important factors that determine interest rates, certainly long term. The Fed does a lot with the short term. The long term, it's inflation and it's real growth. You add those two factors together and you come close to long-term interest rate. Now, I think inflation is going to run 2 to 4%. I think we're going to be above Bernanke's target. Now, you know, not in 6 months or a year, but I think he's going to err on the side of too much inflation. There's a lot of liquidity out there. And I think growth is going to come back. And one should remember, interest rates are not just tied to the U.S. growth, global growth. And global growth, I mean, I look at a lot of different people's projections. Around the world, 4% is still the best guess for real growth. So you get inflation 2 to 4, you get global growth at 4. I do not see how, you know, the German bonds and the American bonds can stay in the 3% range. I think that their risk is upside yields and a big downside on price.
But still a good environment for stocks.
Still a good environment for stocks. Again, in the low to moderate range and at the beginning of an increase. Because remember, the Fed is only going to raise interest rates if it sees the economy pick up. And that's good for earnings. And that's why in the early stages of an expansion, stocks are not hurt by rising interest rates. Because the expansion itself pushes earnings even higher. It's in the later stage when you're at the top of a boom, you know, the margins are unusually high, you're overextended, the labor market is overheating. That's when clamping down by the Fed means a warning signal for stocks.
What about muni bonds? Is there a bubble there too, or is the market set?
Well, you know, they had a little scare there. Miss Whitney, I think, you know, certainly rocked the boat. Got a lot of attention. I'm not an expert in the muni market, you know, and I do know that there's a lot of unfunded stuff in the pensions of a lot of the bonds, but the experts I talked to said, by and large, we are safe in the muni market. And, you know, I have some in muni bond funds and some money in the money market muni funds also, and I have not taken any out. So I still feel confident about that sector. Again, diversification is important. Any one, you know, city or region can go under. But I think if you're really well diversified and stay with the higher quality, and you can do that, I think you're going to be fine.
Now, a big part of return on stocks, as we know, is dividends.
Yeah.
And how much companies payout ratios and the like. What's going to happen if the individual tax on dividends goes from the 15 to, it's going to go up with Obamacare, 2012, it could go as high as 35–40%. That's not going to be good, is it?
You know, and I am very much for keeping it low. I wrote, you know, even before Bush put in that tax cut for dividends, how important dividends are, and we should, you know, our tax code penalizes dividends more than almost any other country, in the sense that we used to tax them as ordinary income. We allow no deduction for dividends on the corporate side, so it's like a double whammy. I can't deduct, and no one gets a preference. Now, we've made, you know, Bush went to 20 and then went down to 15. Now, Obama's original proposal was going back to 20. Now, with Obamacare, I know we have, you know, the first tax from the payroll taxes that can apply to dividends and capital gains. I think that adds another 3%, 3.5% to that, so we can get it up to 23 or 24. And I think that would be a very bad mistake. I mean, I think, I don't like it, but I could survive at 20%. You know, my feeling is that it should remain at 15%, and they should give a deduction for the corporate tax. Of course, we should also lower the corporate tax and broaden and lower it too. So there's a lot of things that are going on there. Would it survive 23.5? I think so, but it's very interesting because I went into Congress and actually testified when Bush was considering, Congress had, of course, consider lowering the tax. I found many, many Democrats in favor of lowering the dividend tax. They were getting a lot of feedback from their own constituency. The reason why they told me they're voting against the plan is they didn't like the other parts of it. And it's interesting because when Obama did it, he said, I'm going to bring those top rates up. But he, from the very early part of his campaign, before even president, he said, I want to keep it at 20, not 15, but at 20. So there is, it's not, there's a lot of sentiment in Congress. And by the way, I think there's enough sentiment. I hope we don't increase any of the taxes. I'm in that camp.